All right, well, unlike prior weeks, we kind of are starting this week by talking about the topic for this week. So I'll be as abbreviated as I can. I'll be as succinct as I can. I think the way people like to use the word succinct is brief, but including all the necessary information. So it's supposed to be like the optimal way of communicating. As brief as you can, no extra information, but everything that you do need. So I hope I hit that sweet spot there. All right, so first of all, we are going over two, we're in this module here. We are in module 10 here, and we're going to be talking about overhead variances and mix and yield variances. So two specialized kinds of variances in variance analysis, and they're at the bottom towards the bottom of the textbook. I think there's section 7.5 and section 7.7 here in the textbook. 7.6 then, they would be the overhead variances. And I give a contextual note saying that I find them less valuable, although not valueless. I find them less valuable than direct labor and direct material variances. Okay, 7.6 still. And I have 7.7, and that's not necessarily what we need to know for doing the problems. 7.8. Okay, so the two sections that we're talking about are 7.6 about overhead variances and 7.8 about mix and yield variances. We're going to go over them in that order. I think 7.7 is interesting and important, but I think I covered a lot of that when I talked about the theory behind standard costing and variance analysis in general. I'm opening two instances of the textbook so I can keep this mountain range, the full one, right here, available. All right, so overhead variances, we are talking about two different types of overhead, variable overhead and fixed overhead. Now, variable overhead follows, at least on its surface, very much the typical pattern for we learned in direct materials and direct labor. There's one little adjustment we have to do, which is what is quantity and what is price. Because with overhead, by definition, overhead are costs that we know are associated with our productive activity, like our manufacturing activity or resale activity for a merchandiser, or something we know is due to the main line of business that we have, the main reason we make money, but we can't trace it to individual product units or individual jobs or whatever. Or I should say, no, I went too far. We can't trace it to individual product units. That's the criteria there. And so we don't know exactly the price of it in the same way we know about direct labor because we're tracking that very closely. We don't know exactly the quantity of it in the same way that we can assign for direct labor. And so we have to review really quickly chapter 4 information, which we skipped over chapter 4 in the course this semester. But it's good background and necessary. It was necessary for chapter 5. And now it's going to come back and be important for overhead variance. At least conceptually it is. So the idea is we have a total amount of overhead. Usually it's considered budgeted overhead. So before the period starts, we are developing a predetermined overhead rate so that we can charge jobs or orders their overhead. We don't know how much overhead they're responsible for, how much overhead costs they're responsible for. We're going to charge them a certain amount based on some sort of estimate of how much they're responsible for. So we have our total overhead, and we're going to divide it by total cost driver. And the cost driver is defined, just like in chapter 5 with ABC, as something that we can indeed trace to those individual product units, or those jobs, or those orders, in the case of job order crossing, like in chapter 4. And here, for chapter 7, all we're going to do is just one cost driver. ABC, we used a bunch of different cost drivers after they were sorted into cost pools, and remember, it's all coming back, right? Well, chapter 4 and by extension, chapter 7 overhead variances here. We're just interested in total overhead over total cost driver. That's our PDOH, predetermined overhead rate. PDOH rate. Now, the idea of that then is to charge individual jobs and orders by that PDOH rate. The problem is, at least one problem that we come up with is the fact that we have put total overhead in the numerator there. It's made up of some overhead that is variable in terms of it going up and down with volume, and some overhead that's fixed. So for example, if we have one overhead amount, which is like electricity, and we run big heavy machinery off of electricity in our factory, then the more we run that machinery, the higher our electricity costs will generally be, with some base level amount that we probably have to incur in electricity costs to keep the lights on. So it would be some sort of a mixed cost with a fixed component and a variable component. Whereas the cost of the lease for the factory itself, it doesn't matter if we're doing 0 units of volume in that factory or 100,000 units of volume in that factory, it's going to be the same amount. The lease is likely to be is fixed, right? So we have fixed overhead and variable overhead. And we're going to pull out variances for variable overhead and variances for fixed overhead separately. And so my point is that the price that we're going to use, like for variances, comes from the PDOH rate. That's our price. We're going to create a variable PDOH rate to reflect, very simply, the amount of the PDOH rate that's due to variable costs. So that would just be variable overhead over total cost driver, total variable overhead. Here, I will rewrite it so it's less messy. And we can separate it into a fixed PDOH rate, which is total fixed costs, fixed overhead costs specifically, over total cost driver. So the idea is these two rates will sum up to the overall PDOH. We're just going to split it into what's its variable portion, what's its fixed portion. And in the case of what we're talking about first, variable overhead variances, we are interested in the price of the variable PDOH rate because that's the rate at which we charge these jobs and orders as they come across our business. And so when we have actual price, when we're talking about standard price over here in these two, we're talking about the variable PDOH rate. So VPDOH is the standard price. And then we also have quantity. The question is quantity. Well, what are we multiplying that PDOH rate by? Once we get the PDOH rate and a job consumes, let's say the cost driver, first of all, is direct labor hours. So this PDOH rate is some number of dollars per direct labor hours. And then we have a job and it consumes 20 direct labor hours. We'll charge it the PDOH rate times the 20 direct labor hours. So the quantities are all cost driver amounts. The actual cost driver amounts for actual quantity and the budgeted cost driver amounts for standard quantity. So let's look real quick at a problem to kind of see how that maps out. Even if we don't go all the way through it, let's look a little bit at a problem like that. We can tie it directly to what you're going to see on the quiz here. All right, variable overhead quantity variance, for example, here. A firm applies variable overhead with a standard rate of $24 per machine hour. Assume there is no fixed overhead for this problem. Okay, so with that little parenthetical, I have said, don't worry about this. The only PDOH rate available is the variable PDOH rate because there's no fixed costs. There are no fixed overhead costs, so you don't have to debate how much of the PDOH rate is due to variable costs. 100% is due to variable costs in this problem. Now, the firm's static budget expected 6,000 finished goods units. Okay, so that's volume. That's not units of variable overhead or units of cost driver that we're going to be using to assign variable overhead. The firm's actual finished goods units were 7,500. That 6,000 versus 7,500 will give us the difference between static and flexible budget here. And so it is a good opportunity for me to trip you up. Don't fall for it. The standard quantity is 1.3 machine hours per finished goods unit. Now that is our rate, our PDOH rate is $24 per machine hour. We're going to be divvying out $24 of variable overhead cost per machine hour. And we expect each finished goods, our standard is each finished good gives us 1.3 machine hours. Takes up 1.3 machine hours. And so from that, we can get how much we would be charging on a standard amount to get this 7,500 actual finished goods units we had. Firm's actual machine hours were 7,500. That's an actual quantity, because the quantity of the cost driver is the quantity we're worried about. It's machine hours in this case. It's cost driver amount, 7,500. And the actual overhead cost per machine hour is $25. So that's actual price right here. Sometimes I'll give that to you, and sometimes you have to derive it out of, I'll say, this was the actual variable overhead cost. And and I'll also give you the actual quantity. And so you have to divide the actual cost by actual quantity. All right, so let's go back. Let's go back to the theory here. You end up with the same kind of variances in variable overhead. You have a price variance, you have a quantity variance, and you have a volume variance. And the important thing about the volume variance is not to include it and commingle it with the quantity variance. Keep the quantity variance and the volume variance separate by choosing the right finished goods units to multiply things by. So in this case, do we want to use that 6,000 or 7,500? If we were looking for the quantity variance, was what it's asking for, do we need to figure out, just use your instincts from last week, do you want to use the actual volume or the static budget volume? The actual volume, thank you, yeah. So we want that 7,500. So let's go ahead and do this real quick. We'll see how similar it is as long as you translate actual price into actual price and standard price into the PDOH rates, and you translate actual quantity and standard quantity into the respective volume or quantity of cost driver. These ones won't give you too many problems. So this is a variable overhead problem. This is machine hour problem. Quantity variance, that's what it's asking for. All right, so we need to use that 7,500 actual volume. We expect our standard quantity per unit is to use 1.3 hours of the cost driver. So when we're talking about overhead, quantity is cost driver. Quantity. 1.3 quantity of machine hours per finished goods unit, per unit of volume. So we should multiply that. All right, this means that we would have expected, if we had budgeted it out and we knew that we were going to have 7,500 actual units of finished goods volume, we would have budgeted 9,750 units of machine hours, which is our cost driver, which we would have then used to calculate all of our important information for variable overhead. All right, so that's the standard quantity. Now just to be complete here, we know quantity variance, same equation. We can use the same equation. Actual quantity minus standard quantity times standard price. Okay, when we know standard price, it was given to us, $24. 100% variable, make a note for that. This particular problem, we can just use the standard price as given to us. Some problems will say, here's the PDOH rate, and 50% of it is due to variable costs. So we would have to say, if that were the case, we'd say, oh, multiply that 24 by that 50%. Oh, this is the variable PDOH rate, or the standard price, or whatever. This is the price we're talking about. But that's not the case in this one. We have 100% variable costs for overhead. All right, and our actual cost, actual quantity, 7,500. All right, comparing these two, is this going to be a favorable or unfavorable variance, do you think? We have our standard quantity, we have our actual quantity of cost driver that we used. Favorable. I didn't hear the full amount there. We only use 7,500 machine hours. We would have expected to use 9,750. So, I forgot to put the parentheses. Times the standard price. That's what the equation here just told us. So this would be our right answer. We got to translate over a lot of stuff from last week, just with a couple extra little rules of thumb about, okay, what's my quantity, what's my price, variable overhead is just a really kind of quirky version of direct labor and direct materials variances. Okay, that's cool. Let's go to fixed overhead. And it looks weird. That's the mountain for fixed overhead variances. And I drew it that way after looking through a bunch of textbooks that don't agree with each other about how to do this. Oh, wait, no, that's the one I want to keep fixed right there. So I even say predetermined variable overhead rate. This is what I have there. I abbreviated there instead of, here I wrote VPDOH. In the book I have PDVOH. All right, fixed overhead variances. Now look, the fact of the matter is there are, I believe, a number of textbooks teach overhead variances using a three variance model. I'm teaching a 4 variance model. So you can either take fixed overhead costs and just take budget or actual fixed overhead costs minus budgeted fixed overhead costs in the static budget, and that's your fixed overhead variance. That's it. That's your third overhead variance. You have the two for variable overhead, and you have 1 for fixed overhead. Or, like I am doing, we can have the 2 for variable overhead. Again, we're ignoring volume. We're acting like it doesn't work. It's like Jan and the Brady's. It gets ignored. But here, we're going to take the 1 and then a second variance for fixed overhead. One is called the volume variance, so fixed overhead volume variance. Another is called the fixed overhead spending variance. Now, I stretched this one out for a reason. I stretched it out because if it's going to overlay and fit on this business right here, it's actually spreading all the way from actuals to the static budget. Why? Why would it do that? Well, there will never be a volume variance, strictly speaking, the way we have used the term before, for fixed overhead. Because the standard quantity at the static budget amount of volume and the standard quantity of fixed overhead costs or whatever at actual volume will be the same by definition because it's a fixed cost. It doesn't vary with volume. Therefore, these two are going to be equal to the same thing. All right, so it goes all the way across here. And likewise, it's not worth pulling out. It's not worth attempting to create causal linkages between the price we spent and the quantity used in fixed overhead, because the reasons why fixed overhead goes up or down from static budget to actual, the reasons for it just don't tend to line up with this paradigm right here. There are very different reasons why you'll have higher fixed overhead costs than expected in actuality compared to what you've budgeted, or lower fixed overhead costs in actuality to what you budgeted. And since the variance analysis is intended to help us improve the business by asking the right questions, don't waste the time trying to pull out a price versus a quantity. You can't do anything with volume because these two would be equal, so there'd always be a 0 volume variance. But then trying to pierce between disentangle between these two isn't going to work. And then the question is, what is this? What in the world is this? Well, this right here is the applied cost. Far box on the right would be to the right, under the normal mountain, would be to the right of static budget and the applied cost here. And I put it to the right because it is more fictitious than a static budget. Nobody's predicting that amount to be the actual amount of fixed overhead. It is a fiction. One textbook calls it a denominator variance. But the point is, it's a fiction of how we do in traditional absorption costing in Chapter 4 staff overhead allocation. So the deal here is, let's say, this will be at least marginally important for Chapter 8 after spring break. Lean has a whole kind of argument about this. The idea is, part of this overhead cost is fixed overhead, like the lease for the factory. It's going to be distributed out to jobs and orders and units based on how much they consume of the cost driver. But in reality, that's a fictitious relationship. The lease doesn't go up or down based on the amount of cost driver consumed. It's just the easiest way to divide it up with something approaching minimum level of accuracy and doing the minimum amount of work for it. In fact, it leads to an incentive to overproduce. Let me pull it up right now, actually. It's one of these images, so I can get to it pretty quickly. Okay, so it leads to an incentive to overproduce. We have this $20,000 of fixed overhead. You won't be able to go through it all right now. I'll just take my word for it as we go through. $20,000 fixed overhead, and if you produce the exact number of units that you're going to sell, then it works out just fine. You end up with an operating income. That's the baseline of $22,000. It's not overproducing anything. But the manager will say, well, that's not my goal. My goal to get the bonus is my division has to get $25,000, or you can say $25 million. We can add 3 zeros if we want. $25,000 or $25 million. So that's not going to cut it. So let's try and overproduce. What that does is that it says let's overproduce by 250 units. Those 250 units will be unsold. And so the amount of cost we pushed onto them through the overhead allocation process remains on the balance sheet, not hitting the income statement. So a smaller proportion of our fixed overhead costs are going to hit the income statement, thereby removing some costs here, which would increase the profits at the bottom. So we overproduce by 250. And look, it pushed $4,000 of costs off of the income statement and left them over here in the inventory accounts. At least I think that's where it's going. We can overproduce by a lot. Let's say we know we only have demand for 1,000 units. We could overproduce by a lot and just have 1,000 extra units sitting in the warehouse. And whoa, we increased our operating income by 10,000 or 10 million if you prefer to add extra zeros. We have a bunch of extra inventory sitting around, which is going to incur costs for obsolescence, incur costs for shrink, incur lots of extra costs for holding it, warehouse space. But that's somebody else's problem in a future period. I got my bonus now. That's all that matters. All right, so the point is that this right here is reflecting a bit of that same idea. And it goes like this. The applied cost is budgeted quantity asterisk. Let me see if I can say it just how it says in the book. This applied cost reflects the fact that we incurred so much cost driver, and based on the budgeted amount of cost driver we're supposed to have in the denominator here, we allocated this much amount of fixed overhead cost to units. Now, it's more of a fiction than our static budget, which all fit together nicely. This is including the fact that we might have over or under allocated overhead, this fixed overhead to units. I think I really just need to get to a problem about this. One of the punchlines is this is called the volume variance. Since there is no way for an actual volume variance to occur in fixed overhead, we call this one right here the volume variance. And this is just called the spending variance. Sometimes people call it just the fixed overhead variance, just alone. All right, so let's look at a problem like this. I'll try and show a little bit more what I mean. So, not spending variance, I want the volume variance. All right, so here's the volume variance. And this is one of the simplest forms of the problem. And this is, because it's a weird way of doing, because fixed overhead is so weird compared to the other three, variable overhead, direct labor, and direct materials variances, I try to keep these problems simple. The fixed overhead problems. All right, a firm static budget predicted $125,000 in fixed overhead costs. All right, so we were in the static budget time frame last September or whatever. We said, all right, well, based on all the fixed costs we know we have a lease we're going to pay. We know we have this salary that's fixed that we're going to pay. It's not going to go up and down with volume. We budget $125,000. We applied $137,000 of fixed overhead costs. That must mean we incurred more cost driver than we thought. Now that's not really going to increase or decrease fixed overhead costs. So this is the most fictitious number on here. It's the furthest to the left, most hypothetical. We wouldn't even have predicted that number. But just by the nature of how we allocate overhead costs in absorption costing, that's the number that got applied in the books. When we count up our actual lease costs in the GL accounts, we have 117,000. Okay, so we have our three boxes here. 117,000, 125,000, 137,000. So just keep those instincts of I'm going to subtract two boxes in the order they appear visually to get the volume variance. Okay, so we want volume variance. We want static minus applied. So fixed overhead, volume variance. We want our static, 125,000. Static fixed overhead costs. And 137,000 applied fixed overhead costs. 12,000 should be the number. Okay. Favorability is the question here. I've repeated whether it sinks in or not because it's a weird concept to wrap your mind around. I've repeated again and again. Hopefully this is the best way to get you to get this rule of thumb in your mind. That it's the most fictitious. Applied is the most fictitious. I put it the furthest left, the most hypothetical, furthest away from actuals. And therefore it follows the same sign rules that we had before. So negative variances, and when we have a negative number, that's a favorable variance. It means when we moved closer to reality, the cost went down. We went from 137,000 to 125,000. That's favorable. So that's a favorable $12,000 variance. And frankly, favorability is one of the most disagreed about questions. If you Google fixed overhead volume variances, which I've done multiple times as I've been checking myself, making sure that I'm not crazy about this, and I have some consistent belief that I'm not crazy. In this regard specifically, the actual textbooks that get printed by professors all agree about favorability. But online, you will find some people who have it reversed. Because they'll say, well, it's applied cost. And that must be the other way around. There are some tutoring accounting sites out there that have the favorability wrong. And so the favorability argument goes like this. This favorability works like prior favorability in the sense that, hey, cost went down as we moved leftward. That means favorable for two reasons. So first, as with prior cost, if the left-hand number is higher than the right-hand number, then it is unfavorable variance in the diagram. See, the diagram above correctly shows the static budget's fixed overhead cost as being more rightward or less hypothetical. So more rightward, more leftward. All right, I'll fix that in the textbook. I drew it right. I calculated it right. I wrote the wrong direction. More leftward. So static is more leftward than the allocated fixed overhead cost. Allocated and applied are synonyms. We use those words interchangeably for our absorption costing questions. Also absorbed is another word we use. So a bunch of A words used in this context. So allocated fixed overhead cost is more contrived than the static fixed overhead cost because allocated fixed overhead cost is based on the consumption of the chosen cost driver. That cost driver more likely moves up and down. That cost driver more likely moves up and down as volume moves up and down. Also fix a typo there. Meaning the allocation matches a variable cost pattern of varying with production volume. So it's moving as if it were a variable cost, and it's not. That's why it's contrived. So the cost driver allocated fixed overhead figure is more fictitious than a static budget figure. The logic from previous cost variances about how to judge favorability as we move from the more hypothetical or more rightward to the more actual, more leftward continues to work. All right, so that sentence is written correctly. It's just right up here. I wrote the wrong direction there. The second reason is capacity. So there's a real practical reason why it would be favorable. Fixed costs are costs you incur regardless of volume. If you have low allocated fixed cost figure, it means you underutilize the capacity you bought with a fixed cost. If I am paying $100,000 for a factory lease and I do not do much with that, I produce 0 units in that factory, I am wasting capacity. That's bad. If I produce 0 units, I will consume 0 units of the cost driver. So applied cost will be 0. So moving from applied cost of 0 to a static budget of 100,000 or 125,000 in this question's example would be unfavorable. That unfavorability helps reflect the fact that probably means I have some unutilized capacity right there. So if you have a low over allocated or applied fixed cost figure, it likely means you underutilize the capacity you bought with the fixed cost, and that wasted capacity is unfavorable. All right, give the example. Let's say you budgeted and paid $100,000 for a factory lease, but you produce a very low volume with that factory, leading to a low cost over consumption, leading to a very low allocated fixed overhead cost figure. The farthest right word square on the board. This is an unfavorable thing. That amount of wasting at least part of the factory's productive capacity that you paid $100,000 for, that amounts to wasting at least part of the factory's productive capacity. Thus, it is also unfavorable from the perspective of unused capacity. All right, so it's good that we do it this way. So this is favorable. Great. All right, I want to move on to mix and yield. Let's do one more problem. Let's make sure we do, let me do 2 more real quick. Let's do that. We'll do another volume variance and a spending variance. So here's a spending variance. And you'll see a pattern here. The fixed overhead ones, again, are stated pretty simply. Yeah, Keely. Yeah, sure. Yes, good idea. All right, so I want to do volume, and I want to do spending. Do we have a volume and a spending? We have 2 volumes, 3 volumes. Ooh, we struck out here. All right, we'll do one of these volumes, and then we'll do an open answer for spending as well. All right, so Palpatine Climbing Gear is a firm that uses a predetermined overhead rate, a PDOH, to allocate overhead. All right, so Palpatine, fixed overhead, volume, variance question. It's open answer. We use a PDOH rate. The firm incurs variable and fixed overhead. The firm's PDOH for the period is $13.03 per cost driver unit. I don't even name the cost driver here. I'm that lazy, or I'm trying to keep it that generalized for you. All right, and 53% is the variable portion of PDOH. The remainder is for fixed overhead costs. All right, so we have a PDOH of $13.03, and it's split up such that 53% of it is over here. The other 47% is fixed overhead. All right, so when we're figuring out this, we're going to need to multiply that PDOH rate of 13.03 times 47% to get our fixed overhead PDOH rate, to figure out what we're allocating our fixed overhead costs based on per cost driver unit. All right, during the period, we actually incurred $34,969 in overhead costs. That's our actual fixed overhead cost. Actual FOH. We budgeted 28,186. That's our budgeted quantity. We actually consumed 1,412 units of the cost driver. It's our actual quantity. What is the volume variance? All right, so first of all, let's figure out the PDFOH, is what it's called in the textbook. That's going to be our overall overhead rate, $13.03, times the portion that's due to fixed overhead, which is going to be 1 minus this 53%. So that inside the parentheses would be 47%. 1 minus 53% is 47%. So 13.03, 47% of that is $6.12. So that's the amount of our PDOH rate that is pushing costs onto jobs and orders, pushing fixed overhead costs onto jobs and orders based on the consumption of cost driver for those jobs and orders. All right, so that means that when we actually consumed 1,412 units of that cost driver, we applied $8,647.23 of fixed overhead cost. Okay. When we budgeted, back in the static budget, we budgeted us consuming 2,186 units of cost driver times that rate gives us 13,387.28. we have the two boxes that were the same in the above problem. Remember, we figured out the boxes up here. We said 125 is the static. We said 137 is the applied, and 117,000 is the actual. We now have the two, static and applied, that we need to solve for volume variance. So we can take the static minus the applied and get the answer. That's the quickest solution for the problem there. Just subtract them. Yeah. Yes. So I took our fixed overhead portion of the PDOH rate, $6.12, and it might be a little more than that. It might have rounded it at 2 decimal points. And we multiplied that by the budgeted quantity of cost drivers. So in the static budget, we would have budgeted to have this $13,000 figure that we have right here. Yeah, Karen. Aha, thank you. So I would have gotten that wrong. All right, 22,168 are budgeted units of cost driver consumption. Our budgeted cost driver consumption. And then, yeah. So is the actual fixed overhead cost just to throw us off? Yes. For if it's a volume variance question, yes. We just need these two. Spending variance question will give you enough for all three boxes, and then any information about the applied over here would be to throw you off. So I'm pretty sure because I just worked on it the other week. This is a brand new off-the-shop quiz, the overhead quiz. I'm pretty sure each of the open answer fixed overhead questions give you enough information to get all three of these boxes. And you only need two of them for whatever it's asking for. So, yes. And then, Brenda, do you have a question? Okay. All right. And I tell you here that I made it so it's always positive. And I try to double check that, make sure several times, but it should be always positive, which means it's unfavorable. We underapplied. That's unfavorable. It means we probably underutilize our capacity in our factory. Also, we're moving towards reality from going to applied to static budget, and costs went up. So we can use both those types of logic to realize it's unfavorable. All right, let's jump into a spending question. We'll do it open answer as well. Can you just show what the static budget was? Yeah. It's just this fixed portion PDFOH, fixed portion of the fixed PDOH rate times the budgeted quantity of cost driver consumption. Okay, fixed overhead. Volume, struck out again. All right, let's try to fixed overhead spending variance. We need that. And I want an open answer one. There are only 6 questions on this quiz because you have 2 quizzes this week. So I tried to split them up in the way that made the most sense. And also I aired, maybe it's because it was the 6th quiz I'd worked on in the shop, as I call it, right? This semester. But I erred on the side of making the questions similar. So you have less chance of getting thrown off is the idea. Yeah. I'm trying to look for an open answer, fixed overhead, spending variance, which I'm pretty sure exists. Do you choose these games with random, or you just think a bitch I don't know. Big Star Wars. I just was on a tear with this one. I don't know. It's like, what's the name? Okay, Palpatine. And then so when I was creating other versions of it, I was like, okay, well, let's pick other Star Wars names because that's a theme. I can go with that. And then I picked True Star Wars. Don't let me tell you different. I picked Thrawn in there Anybody knows that? Yep, back in the day. Yeah. Do I not have? Did I imagine making open answer spending variance question? Like a dream it? Did I skip one? Did you see me skip one? Maybe. I mean, okay. Have to fix something really quickly here. Get them into that test bank. All right, well, let's hope that fixes it. All right. Fixed overhead. No, not in this one. It will show up now. Fixed it, so will show up once we get the right amount of luck. There we go. Spending variance. Okay. So now we have a Palpatine spending variance question. I'm going to grab all this stuff to reuse as much as I can. Spending variance, fixed overhead spending variance. All right. So we have PDOH rate. It's 1197, right there from the problem. And 46% of it is for variable costs. All right. So change that to 0.46. And we've already updated the fact. Now we know that our fixed portion of the PDOH is $6.46. All right, that's just PDOH times 1 minus the variable portion of PDOH gives us the fixed portion of PDOH. All right, during the period, we have actual costs. In this case, the actual costs are relevant, $30,513. Let's update that. Let's write it right. $30,513 in actual fixed costs. And we budgeted $21.93 of budgeted cost driver, $21.93, budgeted cost driver, budgeted quantity. Actually consumed $16.28. That won't be relevant to us. Won't be relevant in this case. What we need to take actual fixed overhead costs minus our static budget to do our spending variance. So what we did is we said the problem gave us the actual overhead costs, this box. We calculated that given a fixed portion of PDOH of $6.46, that's just presented as rounding that way. It's got a tail. Given $6.46 and a budgeted quantity of $21.93 of cost driver, our static budget then would have been that $14,175 in this cell right here. Meaning that the spending variance is the actual $30,315 minus the $14,175.11 that's in the cell that's highlighted right now, which equals $16,337.89. That's the spending variance right there. All right, what cell should we look at? Yes. Okay. All right, I want to rocket over to mix and yield. See if I can explain it succinctly in a very short period of time here. So mix and yield variances are a way of chopping up your quantity variance into two different variances. When you have substitutable inputs. So this is the only instance in which we have problems that deal with revenue, some revenue variances. And I hope I've got those questions right. But there are three big ways in which you'll have substitutable inputs. You might have different revenue streams that could be substitutable. So for example, if they buy online, they probably aren't buying in-store that same product. So those two are kind of substitutable. So we were going to have in our budgeting process of a mix of online versus in-store sales. And we're going to pull out a mix variance. And then the remainder will be a yield variance. We'll calculate it separately as well. Likewise, we might have different workers. So maybe we have really skilled workers and less skilled workers or unskilled workers. And we have a particular mix we expect of skilled versus unskilled. And if we deviate from that mix, that makes it more or less expensive because the skilled workers are going to cost us more than the unskilled workers. They just have a higher rate. In fact, I know somebody who was at their programming job for a good while, had a number of raises over that period of time, and they were very, very, very careful about putting that person onto jobs because of the rate they would have to charge that job for that person's time. So they're trying to very carefully manage the mix of different workers that they have. And direct materials. So this is perhaps the easiest to conceptualize. Now, the examples that I give, you have a big vat of chemicals. It's supposed to be a mix of chemical A, 20%, chemical B, 80%. And chemical A, let's say it's the more expensive one. Chemical B is the cheaper one. If you get that instead, 30-70, that change in the mix has increased the price of that vat of chemicals. Or maybe something that's less jokerish, like, there's my joke. Trail mix. You know that stuff that you eat the M&Ms and throw away the rest? Yeah, so it has a mix of M&Ms versus etc. And it's like never enough. But the M&Ms are probably more expensive than the other stuff, That's probably good for you, but you don't eat. And so if somebody, has their hand and just a little too long on the M&M button or lever or whatever in the trail mix factory, then they might put 20% instead of 10% M&Ms. And that's going to make that bag of trail mix more expensive. Because it's a set volume in the trail mix bag, there are substitutable inputs. You can only put so much inside that trail mix bag. It's going to be certain percentage M&Ms, certain percentage non-M&Ms or whatever. In fact, that is a problem. Candy versus peanuts in the quiz. All right, so these mixed variances work like this. And you can set it up one of two ways. One, you can build the table, which is what I will tend towards. That's how I tested all these questions. And the other way you can do it is use the equation, which is fine. If the sigma summation operation here frightens you, that's what this is, then just build the table, I guess. Either way works just fine. You get the same answer. So here's the idea. You line up and you say, we've got our different inputs. There are always two in these questions, just two inputs, because that illustrates the point. These are mixed variances now. We have our actual total inputs. So it's going to be the same amount. We have a total of 1,000 units that we've input into the trail mix bag or the chemical vat or whatever. And we have our actual mix of these. In this case, we did half and half, input 1 to input 2. 0.5, 50%, and 0.5, 50%. We have our standard price. And so we're going to multiply. So at the actual input mix, our standard cost, our cost would be 12,500. And over here, we have everything, all the same columns, except the input mix is at our standard mix. We should have done 2575 a 1 to 3 mix. One of these input 1s for every 3 of these input 2s. And that's important because input 1 is considerably more expensive. We way overused input 1 here compared to input 2. And so we have instead $11,250. Excuse me, at standard mix, we would have had $11,250. At the actual mix, we had $12,500. Adjusted at standard price still. Just ignore that for now. The lever we're pulling is the mix the standard mix we expected or the actual mix right here. In this case, we have an unfavorable $1,250 variance because you subtract those two. You went from more standard to more actual, and prices went and costs went up based on moving the mix to the actual mix. That's unfavorable. Up here, the same thing. You take the actual input quantity. In this case, it's 500 for input 1. 500 minus the standard would be 250. We should have 250 units. So we have a positive 250 in the parentheses times the standard price for input 1 of $15. So 250 times 15. And you add that, that's what the summation means. You add that to the next input. Input 2, we actually had 500 units of it, minus, we should have had 750 units, so it's going to be negative 250 in the parentheses here, times the standard price of 10. So we have 250 times 15 plus negative 250 times 10. And we'll do that real quick in the phone. That's a calculator. 250 times 10, of course, is 2,500. 250 times 15 is 3,750. So this converts to 3,750, and this converts to negative 2,500. So 3,750 plus negative 2,500, or change that to a minus, gives us the 1,250 unfavorable because it's positive. The same as with the table. Either way works. So that's the mixed variance. Accounting for the fact that if we have substitutable inputs, the quantity variance includes some of the quantity variance is due to the fact that we may have altered the mix based the actual mix versus what we had as a standard mix. Yield. Oh, so yield means the yield variance means that it reflects, let's see, what did I say? The yield variance reflects the variation between standard finished goods output given inputs and actual finished goods output given inputs. So the basic idea is, given all the inputs that we have, accounting for the standard, the mix variance and everything, given all the inputs we have, I should say, leaving aside the mixed variances to the mixed variance, we should have produced this number of outputs. We actually produced this number of outputs, finished goods units is outputs. And so a certain amount of our quantity variance is due to that. In fact, that's the more traditional way of thinking about quantity variance. We phrase it backwards. When we said it last week, we said, oh, at that amount of finished goods units, you should have used this number of direct materials units or whatever, or direct labor units. We actually use this number. Because we're pulling out the mix variance, we create a different name for yield variance, and for some reason, it also gets flipped as how it's phrased. So the idea is we're going to be taking finished goods units as yield. Actual finished goods units yielded minus the standard finished goods units yielded times the standard price at standard mix. All right, they each have a name here, a definition here. So actual yield is the actual finished goods units completed. Standard yield is the finished goods units you'd expect given the total actual inputs at the standard mix. So if we go back to at the standard mix, we expect, let's say 1,000 in this case. We would expect, let's say we have 1,000 units. This example doesn't give us anything. Let me go back. If we have an expectation that it takes 2 direct materials units to create 1 finished goods unit, then that's 2 to 1. Our standard then would be, given 500 direct materials units, we would have expected to complete 250 finished goods units. All right, that's all I'm saying over and over, the same thing. So standard total output divided by standard total input times total actual input. So the ratio of finished goods units to direct materials or direct labor or whatever other input we have, that ratio times the actual amount of input will give us how much we should have, how many finished goods units we should have output, given those number of inputs. We'll get into an example, maybe that'll help. And then the last one is standard price at standard mix. All right, so this one is not too hard to understand. In fact, many times I just give you what the standard price at the standard mix is. Other times you have to calculate it. But the idea is, assuming we have the standard mix, and this is where I could reference the table up above. That's why I was in my head doing that. Assuming we have the standard mix amount, 25% to 75% in that table above, for example, and the price of those, what would our price per finished goods unit be? We're going to multiply by that by our finished goods units to get the yield variance. So standard price of a batch of input units at standard mix divided by the finished goods units per batch. So if we have, for every 100, let's say we have, all right, I'll throw this up real quick. Let's say it takes us one direct material A unit and 3 direct material B units to yield, let's say 10 finished goods units. That's our standard. And direct material A is $5, direct material B is $10. And what we're going to say is, well, for every 10 finished goods units, we would expect 1 direct material A times it's $5. $5 of direct material A cost plus $30 multiplying these as well. $30 of direct material B cost. So $35 total dollars direct material cost per 10 finished goods units. So each finished goods unit should give us 35 over 10, which simplifies to 7 over 5, 7/5 of a dollar. That would be the standard price of the standard mix. All right, let's go through a couple questions, make it extra confusing for you. Oh, let's go here. Mix and yield variance. We'll close that one. All right, so let's jump right into the open answer ones. Let's see if that'll help. So we're looking for a mixed variance. This firm has 2 inputs, X and Y. The firm understands these inputs to be substitutable. That's just going to go without saying for mixed variances. It's just our premise. Our standard mix is 2 X's for every 12 units of Y, and here we have our X and our Y costs. All right, let's build that up. This is a mix variance XY question. Open answer. That instead. So we have 2 X units per 12 Y units. And how do I want to build this table? I want to build it differently. $25 for X and $8 for Y. Okay, now we have total actual units, just moving on. Total actual input units of 4,000, which is 1,000 X and 3,000 Y actual units. So what I want to do to get the mix variance, because that's what it's asking for, is I want to build that table. I want to recreate this table right here. All right, so this is our total actual inputs. We actually input 1,000 X units and 3,000 Y units. We varied from the standard mix. The standard mix is 2 to 12, which simplifies to 1 to 6. Instead, we did 1 to 3. we way overused X units. So it's going to be unfavorable for sure. We overused the more expensive of the two. We used the nice china, if you will. If anybody has different kind of plateware in their house, you know. So we're going to recreate this. We have X and Y. We have actual total input. It's just going to be that 4,000 for both. We have actual mix. I'm going to create the actual mix by dividing the amount for each input by the total amount. So we have 1,000 X units out of 4,000 total units. That's 25%. We have 3,000 Y units out of 4,000 total units. That's 75%. 3,000 over 4,000. Okay, and we can take the standard prices from this table right here, and we can multiply that out. So at the actual mix, we're incurring $49,000 of cost. Now it's standard price, SP. And this is our subtotal based on that table. Okay, let's keep on going. Table says now we're going to do the same thing over here on the standard side. Same 4,000 units. So we actually use 4,000 units, but we would have expected to use 2 out of 14. That's 2 out of the total of these two, the sum of these two, which comes out to 14.28%. See, we actually used 25%. We should have used 14.3%, rounding it off. And we can do the same thing here. With Y, we should have used 12 over 14, which gives us 85.7%. We're going to use the same standard prices and multiply across here. All right, so given the actual mix, we incurred $49,000 for these direct materials. At our standard mix, we should have incurred $41,007. So we can just subtract these, and we get our unfavorable variance right there. Yeah. These right here? Yes. So they're going up to the standard mix here for X and Y. 2 to 12 is what it says in the problem. I'll go to the problem. Standard mix is 2 units of X for every 12 units of Y. So in total, that's reflecting 14 total units of input. 2 out of the 14 are X, 12 out of the 14 are Y. And that's what I'm doing here in these cells. Saying 2 over 14, 2 plus 12. And then the other one is 12 over 2 plus 12. Just getting the ratios in there. And it's always times standard price. In fact, throughout this quiz, use standard price, never use actual price. That shouldn't confuse you, because there are lots of actuals you use, just not actual price. Because we're way over here. Mix and yield are trying to break up the quantity variance into 2 usable portions. When we have substitutable inputs, we might find more use in figuring out how much of that is due to mix, how much that's due to yield. All right, let's try and sweep through real quick a yield problem. Yield variance. All right, we have 2 labor inputs, senior and junior laborer. Standard mix is 2 senior labor hour per 4 junior labor hours. All right, so we have 6 total labor hours. 2 of them, 1/3 of them, that is, 2 over 6, should be senior. 2/3 of them, 4 over 6, should be junior. And we have yield open answer. All right, we have 4 total hours as the standard hours of input for a single finished goods unit. All right, so for every finished goods unit, we should use 4 hours total. Senior laborers cost $23 per hour, and junior laborers cost $14 per hour. That's their rates. The firm has actually completed 10,229 finished goods units and used 38,756 total labor hours. All right, so we're going to have to do, most of this paragraph is to get the standard price at the standard mix, the price we're going to be using. Much of the work otherwise is actually right here. So we have actual yield given to us. We'll go back to the equation real quick. Actual yield right there is given to us. It's that 10,229. Oh, in the wrong. That's the actual yield. Now the standard yield says here, we used 38,756 labor hours. Given the standard of 4 labor hours per finished goods unit, that'll give us a standard yield. So we have 38,756. This is actual total inputs. We have 1 over 4. Nope. That is the ratio of FG to input. And so we should have produced 9,689 yield. That should be our yield, finished goods units we produced, given this amount of input. Oh. Okay, now we have the two items inside the parentheses here. The difference between those two is inside the parentheses. This and this. Oh, these two cells. Actual yield minus standard yield. So we have 540 extra units of yield. We got like extra bang for our buck. We need to multiply that by a price so we can give it a dollar amount though. Okay, let's go to the problem. At the standard mix of 2 to 4 and 23:14, so standard price of a batch of input units at standard mix divided by how many finished goods units there are per batch. So I created a batch with 6 labor hours at $102 per that batch. Here, it says it takes 4 for a single finished goods unit. So I'm going to have to convert that. I'm going to say 4 over 6. This is labor hours per finished goods unit divided by labor hours in my batch. So that should get us standard price and standard mix. And spellings aside. All right, that should be our answer here. Let's see if that works. So what I did is I figured out what was inside the parentheses. The problem gave me actual yield. I calculated standard yield by saying, well, given this number of total inputs, labor hours, and the fact that we should get 4 labor hours, we should have 4 labor hours per finished goods unit, we should have produced 9,689 standard yield. So that's the difference inside the parentheses. And we're going to multiply that difference by standard price at the standard mix. Oh, that's wrong. That's standard price, standard mix. Because I took the different types of mix, different types of input, times their prices, and then converted that 6 hours of input into the 4 hours needed to complete a finished goods unit. So given $102 to do 6 hours of labor, divided by 6 times 4, that's what that is, 4/6, gives us $68 standard price at the standard mix. All right, we'll come back to yield and whatnot. If you pulled questions already for the overhead variance, there might be a problem with the spending variance questions that I just fixed here in class. If you're seeing weird things with those volume, with specifically the fixed overhead volume variance questions, they're asking for that. That might be the problem. So you might have to get an extra attempt. No problem.